I want you to imagine you started investing in 1998. The internet is growing fast. New companies appear every week. Investors believe they found the next big thing. You take all your money and put it into a few tech stocks because they have .com names. Your money rises for 2 years. People think you are a genius. Then the year 2000 comes. The market collapses. The Nasdaq drops almost 80%. Only half of the .com companies survive. Many investors lose millions. I expected a crash, but my own portfolio still suffered. The internet was the next big thing, but hype and overconfidence created one of the biggest bubbles in history. Fast forward to today. The same energy is back, but now it is driven by AI. People call it a once-in-a-lifetime opportunity. Maybe they are right. Maybe this is another bubble. History often repeats in different forms. Every generation believes the new technology will break all rules. Over 7 million of you started investing because of my videos. I feel responsible to give you my honest view. Before you panic, we need to look at the 3 forces behind this potential bubble, why they matter, and how you can benefit from the situation. 1. The AI arms race. 7 companies are driving the entire stock market. They are Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. Together, they are more than 1/3 of the S&P 500. They are racing to dominate AI. Even if you buy one index fund, you're already betting on these companies. Your future returns depend on how this race ends. Their spending is massive. Tesla plans to spend $5 billion. Apple plans to spend over $10 billion. Meta plans to spend $60 billion. Google will spend $75 billion. Microsoft will spend $80 billion. Amazon will spend $100 billion through AWS. That is $330 billion in a single year. It is more than the GDP of many countries. This spending is keeping the US economy alive. Without it, the country might already be in a recession. Global AI spending could reach $500 billion by 2026. Demand for electricity for AI could reach $3 trillion per year by 2030. AI could impact 60% of jobs in developed countries. Whoever leads AI will hold enormous power. That is why companies and countries are fighting for dominance. Your investments could rise if AI delivers real profits. If profits do not come fast enough, the same companies lifting your portfolio today could pull it down later. 2. The AI money machine. There is a loop of money between chip makers, AI companies, and data centers. Chip makers like Intel, AMD, and Nvidia design the hardware. AI companies like OpenAI and xAI buy the chips. Data centers like Oracle and CoreWeave also buy chips, then sell computing power back to the AI companies. Here is the concern. Microsoft invested $58 billion in OpenAI. OpenAI paid Microsoft back by using Microsoft data centers. Microsoft then bought Nvidia chips with that money. Nvidia then invested money back into OpenAI. Each company records this as revenue. This cycle pushes valuations higher. OpenAI signed a $300 billion deal with Oracle. Oracle will buy tens of billions of dollars of Nvidia chips. Nvidia will invest up to $100 billion back into OpenAI. OpenAI must buy more Nvidia chips to unlock that investment. Nvidia is the biggest winner. Its stock price is up 16 times since ChatGPT launched. OpenAI is valued at $500 billion but makes about $12 billion in revenue. It loses money every month. AI services are not earning enough yet. However, these companies still have options. 700 million people use ChatGPT weekly. That is a huge data and attention base. Ads could bring significant revenue. Companies could pay to appear inside AI chats. OpenAI will also allow adult content for verified users, which is a large industry. AI companies also plan to replace human labor. Once businesses depend on AI, they will keep paying even if prices rise. 3. The AI data wall. AI has grown fast because it consumed almost all available public data. By 2027, AI will likely have used nearly all human-generated online content. Progress could slow down. AI needs new types of data, not just more data. Humans learn through experiences. AI does not have that. Companies are trying to push past this limit, but it is unclear if they can. My thoughts on what you can do. This is not the same as the dot-com bubble. AI companies have real products and real demand. They have a path to profit, but the size and timing of those profits are unclear. The signs of a bubble still exist. Valuations are high. Money is looping between companies. Nations are competing. Data limits exist. The bubble could grow for many years or burst sooner than expected. The best move is to continue investing in a broad low-cost index fund every month. Do not panic if your portfolio drops. Crashes create long-term opportunities. I did this during the dot-com crash and it paid off years later. Increase your income. A higher income gives you more money to invest. Diversify your investments. Spread your money across different assets. Stocks, bonds, gold, real estate, and cryptocurrency each react differently to market cycles. Dividend stocks can help during downturns. If a bubble bursts, it is not the end. If you understand what is happening, you will not panic. You will spot opportunities. Others will run away. You will move forward.